Are you familiar with the saying that identifies the main source of problems? Avoid falling into debt. It equates to bondage, and this holds some truth. The reason is that being burdened by debt essentially ends your life. As you struggle to settle your debts, they don't pause for you. Instead, they increase daily. Remember, borrowing money isn't free since interest is always involved. Despite this reality, it's noteworthy that the total consumer debt in the United States is close to $15 trillion, averaging over $5,300 per household. With the US GDP just above $21 trillion, it's evident that the economy is largely composed of this debt. However, I bring you encouraging news. This situation isn't always detrimental. This view might not be popular, as most of our debt is considered negative. Chances are you have credit card debts, a car loan, and possibly student loans, and you're thinking it'll take a lifetime to clear these debts. How can that possibly be advantageous? To grasp how this can be beneficial, consider how wealthy individuals leverage debt to increase their wealth. This may seem perplexing. Why would those who are financially well off opt for debt? Debt is commonly thought to be for those lacking funds, yet that's not the case in a capitalist system. When used wisely, debt becomes a formidable instrument, and this video will reveal how affluent people utilize debt to further amplify their wealth. Firstly, it's important to recognize that a significant portion of commerce relies on debt. This might seem contentious, as using borrowed funds to start a business is often seen as a risky move, and personally, I would avoid it. However, in many traditional business models, employing debt can actually be the most viable strategy. Consider, for example, selling pens, a product with consistent demand. The ideal approach would be to travel to China, identify a factory that manufactures the desired quality and type of pen at a reasonable price. Purchase a container of these pens, then ship and distribute them in the US nowadays. This process is predominantly conducted online through platforms like Alibaba, except for more complex products which may require a visit to the factory. Here's the interesting part. You don't need to initially pay for the products to obtain them. Over the last 50 years, China has evolved into the world's manufacturing hub, with thousands of factories continuously producing a wide range of goods. To facilitate sales, many of these factories are willing to offer their products on credit, expecting payment at a later date. Naturally, they won't extend this credit to just anyone. You'll need to establish a level of trust first. This method has underpinned business operations for the past 5 decades. Once the client sells the product in the US or elsewhere, they then pay the factory and acquire more products on credit. Essentially, you're proposing to the factory, "You excel in production, let me handle the sales. Any amount I sell it for above this price is my profit." The brilliance of this approach lies in not having to invest your own capital in the transaction, underscoring why salesmanship is among the most valuable skills one can acquire. Secondly, refinancing real estate debts stands out as the most advantageous form of debt due to its numerous loopholes. Without a mortgage, you're essentially paying more in taxes. Wealthy individuals often maintain several mortgages to capitalize on these tax deductions. It's crucial to remember that every dollar you save on taxes is effectively an extra dollar earned, contributing to the wealth accumulation of the rich. Now let's explore a more tangible example in real estate. Suppose you've managed to save $200,000. While significant, it's relatively insufficient in the real estate market, not enough to buy a house outright. However, with a 20% down payment, you could qualify for a mortgage of up to $800,000. The key strategy involves finding a property worth $500,000, perhaps in poor condition and requiring renovation. You approach a bank for a mortgage, making a 20% down payment. Assume you spend about 10% of the house's total value, or $50,000, on renovations. After renovation, you return to the bank to refinance the mortgage. Initially, the property's value was $500,000, reflecting its poor state. Post-renovation, the market value potentially increases to $700,000, making it attractive for renters. If you secure an 80% mortgage on this new value, that amounts to $560,000. Of this, $400,000 settles your original mortgage, and $50,000 covers the renovation costs, leaving you with a profit of $110,000. This profit is generated through debt, and you still retain the property, which can now generate rental income and build equity. Moreover, having a mortgage means you can reduce your tax liabilities. This approach is widely used by real estate investors. Reflecting on this, can debt still be considered inherently bad? I'll leave that for your contemplation and comments. Point 3. The essence of hedge funds. Hedge funds are established by affluent individuals for the same demographic, with the aim of further increasing their wealth. They often adopt contentious investment tactics. Ordinary individuals like us strive to identify which companies will prosper and grow in value, investing our hard-earned money in the hope of their expansion. In contrast, hedge funds frequently employ a diametrically opposite approach, seeking profit from the decline or bankruptcy of companies, as exemplified by the GameStop incident. In this case, online communities confronted hedge funds, leading to their staggering loss of over $13 billion. But what's the mechanism behind hedge funds profiting from debt? Imagine you foresee a decline in a particular stock, such as Facebook, anticipating that Apple, the leading smartphone maker, will soon announce a new privacy-focused policy that impedes tracking by apps like Facebook or Instagram, potentially undermining Facebook's revenue model. You'd then call your broker to borrow a single Facebook share worth, say, $100 and immediately sell it for the same price. Congratulations. You now have $100, but owe a Facebook share to your broker. Suppose your prediction is accurate and Facebook's stock drops to $70 the following week. You could then buy back a share at the reduced price of $70, return it to your broker, and keep the $30 difference. This strategy sounds straightforward, but is in fact quite complex and fraught with risk. What if your prediction fails and the stock value doubles overnight? You're still obligated to return the Facebook share, even if it means purchasing it at $200. Unlike traditional stock buying, where losses are capped at your initial investment, short selling can lead to escalating losses, potentially unlimited, as stock prices can theoretically increase indefinitely. However, with an extensive team of analysts, one could potentially amass significant wealth through this strategy. Point 4. An overview of Forex. Here's a brief explanation of how it functions. The Forex market is where different currencies are exchanged, facilitating international trade. For instance, you cannot use US dollars in China. Instead, you need to purchase Chinese yuan to pay employees there. This market allows individuals and companies to buy and sell foreign currencies. Currency values fluctuate based on various factors. For example, if the Federal Reserve increases interest rates, this generally strengthens the US dollar against other currencies, and the opposite effect can occur with a rate decrease. The ability to predict these rises and falls in currency values can lead to substantial profits in this market. What distinguishes Forex from other markets is the leverage it offers. For every dollar invested, you can borrow an additional $100. So, with an investment of $1,000, you can control a position worth $100,000. Even a small profit margin, like 1%, can translate into a significant gain due to this leverage. Point 5. The significance of a credit score. As evident, a credit score is a crucial tool utilized by successful businesses, companies, and entrepreneurs in numerous ways. Particularly for those with a proven business model, utilizing debt to finance purchase orders is a common strategy among almost all businesses. It's important to recognize that not all debt is detrimental. Certainly, debts carrying high interest rates, like those from credit cards, are unfavorable. However, to access lower interest rates, one must reduce the lending risks. This is achieved by establishing a history of reliable borrowing. Banks hold billions, possibly trillions, of dollars ready for lending. Additionally, as mentioned in a previous video, banks have the capacity to generate money. If you found this video informative, please give it a thumbs up. For those new here, don't forget to subscribe and activate notifications. Welcome to the channel where you'll learn all about money, investing, and the stock market. Thank you for watching, and I look forward to seeing you in the next video.